Hi, I'm Omid Shakurnia, Head of Research at Research Affiliates. Today in this video, we're going to be demonstrating the newly improved portfolio view and analysis tool in Asset Allocation Interactive. And we'll show how to build portfolios from any of our 140 plus asset classes that are modeled on the site. In particular, we'll build a portfolio of the 18 new public equity markets that we've added. And along the way, we'll see the benefits of diversification, both in terms of return and risk. And this exercise, in addition to demonstrating, how to use the portfolio view tool, we hope will give you a stark example of Harry Markowitz's famous saying that the only free lunch in investing is diversification. So let's dig in. First thing we're going to do when we log into the site is we see this risk and return chart. Now, by default, the risk and return chart shows only the top level headline asset classes that we've modeled. What we'll do first is go over to the left and click on all. This adds a view of every asset class that's modeled on the site. And we see now there's a whole lot of new asset classes, in particular, many with pretty high levels of return and risk. So let's take a look at what these are. We see here Colombia. It's got a expected 10-year real return of nearly 20% and a volatility of 36%. Let's go to the next one. Czech Republic. It's got an expected return of 17% and a volatility of about 25%. Now, these are substantial returns, and a lot of these returns are coming from yield, right? The dividend yield on Czech Republic is 12.7%. In Colombia, dividend yield is 10%. So we see that yield is out there for investors looking for yield. And as long as you're willing to invest internationally, there are high returns to be harvested. So now that we've taken a quick look at the risk and return for a number of these new equity markets, let's go ahead and build a portfolio from these markets. What we'll do is on the left, under the portfolio section, we'll click on this link that says create a new portfolio, and we get to the portfolio view. First step is to give our portfolio a name. Let's call it New Equity Markets. From there, we're going to choose the asset classes to add to this portfolio. Portfolio building is a two-step process. Step one is choosing the asset classes that you'd like to invest in. Once you choose the assets, that selection step, the next is the allocation step, choosing how much to invest in each asset. And what we'll do is go ahead and select all of these new equity markets. There's 18 new equity markets, so we're just going to go ahead and click on them one by one. Within emerging markets, we have Chile, Colombia, Czech Republic, Egypt, Hungary, Israel, Peru, and the Philippines. So these are 18 new equity markets. What we see next is the screen, which has all of these equity assets available by default. There's zero allocation to them. And the next step we'll do is go ahead and allocate to each of these. For this exercise, I'm going to keep it simple, and we'll do 5% allocation to each of these markets, 5 for each. And what you see happening on the left is with each new allocation, the uninvested cash is being reduced and being allocated to a new market. And as you do that, the expected return and risk for your portfolio will evolve. Okay, so now we have 90% allocated in each of these markets and 10% still in T-bills. For this exercise, we'll just leave that as is and save this portfolio. Now that you've saved this portfolio, it'll be there next month, next year, and so on, and you can evaluate this portfolio as time goes on. What we'll do next is compare this portfolio to a reference. And a good reference for this will be an all equity model portfolio. So this all equity model portfolio is from the suite of the RA model portfolios. What we see immediately is notice the risk of our new portfolio and the all equity model portfolio are almost the same. They're both right around 16%. That's interesting because if you recall, many of these markets, we saw Colombia, Czech Republic, Chile, a lot of these markets had very high levels of volatility. But when you build a portfolio out of all these assets, the volatility came down to much more reasonable levels. How does that happen? Well, that's investing 101. The diversifiable risk, idiosyncratic risk in these markets is washed away when you build a portfolio out of all of these asset classes together. So that's step one. A big benefit of diversification is taking risky assets that have relatively low cross correlation with each other and building a portfolio of them can reduce the idiosyncratic risk and overall portfolio risk. But there's more. Let's take a look at the drivers of return. We see that the new equity markets have almost 3.5% higher expected return than the all equity portfolio. And what we can do is take a look at where that's coming from. We decompose our expected returns into yield, growth, valuation change, and this additional column, additional row here in this table called diversification return. Let's take a look at each. The yield, the dividend yield of our portfolio is nearly 2% higher than the all equity portfolio. Remember, these assets had high yield to begin with, so a portfolio of these assets will have high yield. That's pretty obvious. The expected growth and valuation change of these two portfolios are very much in line with each other. There's not a whole lot of differences between them. The yield definitely is a big difference, and also the diversification return. A little over 1.5% of the return benefit in this new portfolio is coming from diversification. Where does that come from? Well, that's the rebalancing premium that you get by building a portfolio of lowly correlated assets and rebalancing that. That rebalancing process of buying low and selling high harvests the return in those asset classes. And that in this portfolio, it's pretty high at almost 1.5% higher than the ramp all equity portfolio. And so we see in this exercise that there's two very large benefits of building a broadly diversified portfolio. One is the reduced risk. Each of these assets had fairly high risk, but when you build the portfolio, the overall portfolio level risk is reduced. And the other benefit is that rebalancing premium, the diversification that you get from rebalancing these asset classes. So indeed, this serves as a very nice example of Harry Markowitz's saying that the only free lunch in investing is diversification. We hope you enjoyed this exercise. We encourage you to go and build your own portfolios, explore the portfolio view and analysis tool. As you build portfolios, dig into the drivers of risk and return. And we hope that you'll find this educational and informative exercise to really explore, the drivers of risk and return in the capital markets.